and welcome to Money Control. Hope all of you have had a good start to the year, although the markets are keeping us anxious. There is a lot of noise in the market, too many things and not so pleasant things coming together at the same time. The risks around Trump coming to power, persistent foreign selling, a strengthening of the dollar and weakening of the rupee, a slowdown in government capex spending and economic growth, earnings slippages, and all of this when valuations are at the higher end of the historical averages. This is the time you can easily get things wrong, wipe out a lot of the money that you've made in the past. So here we are to help you navigate this year, that is 2025, better. And central to this is to stay focused and not get distracted by unnecessary noise. So we kickstart this special series today, 5 ideas for 2025. These are a mix of big trends that will define this year, important investment lessons, or you may call them investment truths that you can't afford to ignore or forget, and ideas that are actionable, both themes and stocks to consider, of course, with the usual caveats that this is not advisory in nature and you need to do your own due diligence and consult your portfolio consultants and advisors before acting on anything that we talk about here. So today we kickstart the series with a very young but sharp portfolio manager, Jigar Mistry, who runs Buoyant Capital. Thank you so much, Jigar, for joining me on this show. First of all, wish you a very, very happy New Year. Tell us, have you taken any New Year resolutions?
Hi, Mahalakshmi. Thanks as always for inviting me on your show. Yes, lots of resolutions for the new year is to keep the resolutions on for the last year. So more of the same, I guess.
Okay, cool. So shoot, no questions from my side. 5 big ideas for 2025. What's your first idea?
Okay, so the first idea, Mahalakshmi, is that I think, the earnings slowdown may not be as temporary as we think. Right. So the first narrative thereon is that essentially because of the general elections, and all of us know how much those costs. Because of that, there was a significant withdrawal from the formal economy, and that has led to the drop in earnings. Our sense is that if you take a step back and realize what was driving India's growth, then we realize that it may not return in a hurry or as much as the street is estimating for sure. Why do I say this? Because if we break down into 2 broad parameters, first is the consumption piece and then there is the capex piece. Consumption, our belief is that if you look at the bottom 40% of the households in India, their income, even adjusted for inflation, has not gone up in that higher number. Because of which I think what's happening is that, you are seeing the sort of tepid growth in most of those FMCG plays. The growth was driven by sort of capital spending across parameters. So if you look at the gross fixed capital formation in India, there are 4 large pillars: central government spending, state government spending, private corporation spending, and essentially your real estate and house dwellings. Now, across all 4 of them, 2 of them I think may have hit a high of sorts. So central government has budgeted for whatever it could budget for. I think they might not be able to do a lot more. Private corporation spending, our belief is that it may never return to those pre-2015 highs as a percentage of GDP because, now the capex is a lot more responsible compared to what it was back then. The key changer here is basically how state government spending is changing. And if you look at the last 12 elections, the capex in those last 12 state elections is something like 4.2 trillion INR, whereas sort of the freebie budget, for the lack of a better word, freebie budget is something like 3.6 trillion INR. So I think the state government's choice to spend a lot more socially is impacting the ability to do capex. And lastly, real estate and house dwellings, etc., might take a bit of a breather after a good 3 or 4 year period. So when you combine these 2 sort of broad parameters, you realize that the slowdown that you are seeing post-COVID, the rise in earnings that we saw, I think there is a time to take a breather on this, and we may not return to those 15, 16, 18, 20% sort of earnings growth that many of these companies have been reporting.
Quickly, just to, you pointed out four things, right? Household capex, state capex, central government capex, and the fact that consumption for the bottom 40% has not recovered or grown as one would have expected it to grow. Now, I wanted to ask two questions particularly. We keep saying that the central government's ability to spend is curtailed, but the fact is also that we have pulled back a lot in terms of fiscal deficit. Do you see some headroom? Because people are now projecting 4.9%, 4.5% deficit for next year. If they were to prioritize growth, you can go a little easy on fiscal and you can still create headroom for government capex to continue till private capex becomes ready.
So I think that's the central piece that the central government in India has been targeting, Mahalakshmi. But the issue is that my belief is that this government wants to be extremely fiscally prudent. Besides that, a central government's capex program essentially is only NHAI and Indian Railways, right? Everything else is either in the concurrent list or in the state list, and therefore, unless state starts to pick up, so traditionally they used to be between 1.2 to 1.4 times central government spending. Today we are talking of 11.5 lakh crores of central government spending versus only 8 to 8.5 lakh crores of state government spending. So clearly, either they decide to devolve a lot more to the states, but then the center would worry that that might get announced as freebies. So they're not doing that. And they might not, their ability to spend directly is limited because, as I said, they can only do it with very fewer revenues. So, and I think the government is conscious with regard to sort of leaving a legacy, if not anything else, and therefore they might want to get that AAA rating for India. And the part to that is a continued fiscal prudence. So, looks difficult if I have to guess.
Okay, so even if it were to be a trade-off with growth, you think they will continue to be on the path of fiscal conservatism or prudence or whatever you call it?
Correct.
Second question is on consumption. How long do you think it will take for the consumption piece to get reset? Because that will then give confidence to even the traditional private sector industries to actually invest and kick off private sector capex in a big way. So when do you see the consumption piece, how long will it take for the consumption piece to come back to decent growth?
So Mahalakshmi, it's not that the per capita GDP is not growing. It's just that the Gini coefficient around it is much more wider than one would have hoped. And therefore, consumption is happening into specific areas. If you look at private sector capex in and of itself, in an absolute number, that's almost at an all-time high. So if I look at all private sort of capex, that's a number around 20 lakh crores, of which listed companies contribute around 8 odd lakh crores. That 8 used to be around 4.5, 5 a few years ago. My sense, however, the point that I was mentioning, however, was that when you compare this number to a certain, GDP as a denominator, then that proportion, that ratio has not kept abreast. And as I was mentioning earlier, the rules around capex in India, in the Indian banking system, with the insolvency and bankruptcy code were rather lenient. So you had a lot of people doing private capex, which I don't think will be all that gung-ho now. The demand environment in specific areas, in specific sort of PLI sectors, for example, renewables, all that will go on. But all that combined will not sort of drive a next wave of growth as we are seeing it at the moment.
Now, within the earnings piece for this year, Jigar, what do you expect the earnings growth to be? Most people are projecting that this year, that is FY25, we will still close with just 5% growth. And next year, most people expect, right now the consensus is that you will still hit 14 to 15% in FY26. Do you think it will rebound to 14-15% FY26, or you think it'll take much longer? Because that's what you started off with, that earnings growth may not come back as quickly as people expect it to be.
My sense, Mahalakshmi, is that if you look at a 10-year rolling return on Nifty, we are at around 12% EPS CAGR. This year, some part of it could be because of general elections and therefore you are of a lower base. Next year, therefore, you could sort of see some amount of normalization. So 2 years combined, my sense is that will be below the trajectory of that 12 to 13%. So combined, I think will be at a lower number, but that can be unevenly spread between F25 and F26.
Okay. And which segments in particular do you think are more vulnerable to downgrades from here on? And are there any pockets where you think there could be positive surprises on the contrary?
Positive surprises could sort of be at the consumption end, because that's where sort of the expectations are fairly low. If we break this down in two parts, Mahalakshmi, one is how the absolute growth will be vis-a-vis trend, and second is how much of it is priced in. Now, if I look at how much of the growth will be vis-a-vis trend, I think a large part of capex bucket, investment bucket will, I think, surprise on the negative. We are seeing reasonable amounts of stress also into some smaller cap businesses. MFI particularly is reasonably alarming. Where there could be upsides, I think will be consumption, to some extent large private sector banks and healthcare businesses. So that's the first part. The second part is how much of it is priced in. I think people are not really expecting a lot of upsides from consumption. I think that could surprise. The other part is in terms of positioning. Technology, for example, or IT services in India, they're trading at almost a top quartile multiple with bottom quartile earnings compared to their 10 years. But I think there is some amount of relief in people believing that eventually it's reasonably unharmed, given the positioning, the domestic economic positioning in India, and therefore it still warrants a bet. But purely from an earnings standpoint, I think consumption, healthcare, and large banks should positively surprise. Capex investment themes could surprise negatively.
Your second idea?
Second idea is, I think if you look at sort of continued flows, can't really drive fundamentals, right? So the central argument or the central narrative this time around is that if you look at the, household savings that gets into equities, even if I take a 3 lakh odd crore sort of inflow into mutual funds today, we are still at around 4% odd. Now, in the early 90s, 1992, 93, that number was almost at 15%. And obviously, there was a frenzy around the Indian equity markets back then. But today, from a 4% number, if you look at 2 or 3 years out, and you continue to build in that 10, 11% nominal GDP growth, and this 4% going to say somewhere around 9 or 10%, then you can arguably sort of state that the mutual fund flows will more or less triple from where they are. So it's easier on Excel to build a 9 to 10 lakh crore sort of mutual fund flow. But flows alone cannot drive or sort of fundamentals is what we would like to believe in. Because if you look at the past 10 years rolling returns or 5-year rolling returns across indices, large cap, small cap, or across stocks, then it's fairly clear that you are seeing the EPS growth and share price growth have been fully aligned. In between, there were a lot of narratives. Early 2000s, there was this dot-com narrative. Between 2002 to 8, there was capex. 7 to 8, there was real estate. 14 to 19, there was consumption. And despite all of this, when you look at it from a fairly long period of time, you will more or less agree that the EPS and the share price growth is always aligned. So in physics, there is this concept of self-organized criticality, which essentially states that whatever is, sort of untenable will find a way to topple over. Whatever is unsustainable will find a way to topple over. And something or the other could sort of come in, which could trigger the realignment, but that realignment will eventually happen. And earnings growth is fundamental. Flows are a dependent variable, not an independent variable.
Jigar, going by, a historical record like 20 years, 25 years, like you're talking about, definitely this seems correct. But the other side of the argument is also that this is exactly what is different this time, and therefore benchmarking against, the pre-COVID period, which is the large part of the data, is not quite correct. How do you contest that?
As in that narratives will continue to hold on is the central argument?
Yeah, I mean that we might get into a phase of elevated valuations because the flows are so strong. So you might not see significant correction.
Possible. For the shorter term, Mahalakshmi, it's always possible that narratives hold on to more longer periods of time than fundamentals would. But any serious sort of fund management exercise starts with the belief on whether you would want to drive at the road, looking at flows or fundamentals. If you're just looking at flows, then you will eventually come across something that will not make a lot of sense but drives a large part of correction, right? For example, the whole scare around the new virus. I've not really ever seen the markets react to the same piece of news twice over, although sort of behaviorally and psychologically it's an important piece. But that could as well become a trigger to realign things rather than be of consequence in and of itself. So the narratives could last longer than what we are happy to build in. It always does because it's taking an extension from human psychology. But if you are a serious fund manager or a serious investor, you would look at what is that independent variable and not a dependent variable, and thereby you will define whether earnings drives valuations or valuations drives earnings. Now, we would like to believe that if the economy is growing, companies are growing, and that essentially looks at flows and not the other way around. So I think you could choose to drive, as I said, looking at one of the either, but we choose to look at earnings and drive accordingly.
Jigar, this also has another, fallout in terms of, how we think about the various segments in the market. And most fund managers, I don't know where you stand on this, at least for the last 2 years, have been saying that it's the mid cap and small cap space that is done really well. It's time for the large caps to actually start doing well now, because that has got relatively, if you just benchmark it against prior period valuations or historic valuations, it looks like the large caps are the undervalued lot, relatively undervalued lot in the market. But part of that explanation is also how flows have come in. Most of the retail and domestic flows have actually chased mid caps and small caps, which is what has led to this rise in valuations there. Most of the selling has happened in the large caps, which is what has depressed valuations there. So when you say flows won't determine stock price movements or fundamentals will have a greater bearing, where do you stand on, how to navigate this large cap, mid cap space?
Right, Mahalakshmi. So clearly flows in the shorter period of time do impact share prices. There are no two ways around it. What my central argument was that whereas in the shorter term, you might see the consequence of flows. As an investor, it is slightly more difficult to predict flows compared to earnings. I'm not saying they are perfect or anywhere close to being perfect on calling out earnings, but our ability to predict them is slightly higher than just predicting flows. So therefore, sort of you choose what you want to drive with. To your question on sort of large versus small mid caps, the data is quite succinct here, right? So if I look at the total retail ownership in the low of COVID, so low of the market or peak of the pandemic in COVID, the total retail ownership excluding mutual funds was around 16 trillion INR. In September, that number had grown to something like 69 trillion INR. Retail as a cohort has generated a wealth in excess of 50 lakh crores. To put things in perspective of how large that is, whatever India saves in real estate, gold, silver, equity market, debt mutual funds, and bank deposits at a net level last year was around 14 lakh crores. Right? So there are 100 crore savers who save 14 lakh crores. There are 10 crores or thereabouts active demat account holders who have generated in excess of 50 lakh crores in under 5 years. And they think, and large part of this is in the small and mid cap space. And they think this is the best sort of place to keep getting invested. The problem is that the free float market cap of small and micro cap is a third of large cap, whereas the size of mutual funds is almost similar. And that is creating, if you want to call it, a virtuous cycle for stock prices at the moment. And if it's doing good, more money is attracted to the same stocks. And that's a virtuous cycle until, as I said, self-organized criticality takes over, and then it's the spiral other way around, and it becomes a vicious cycle. So you are right that over the shorter term, the flows will determine sort of how this business is fair. And if earnings are backed up, then sort of things might continue to rise for a while. But our belief is that there is a reasonably large asymmetry between information and insight in some of these narrative stocks, and you will only need a sort of nudge, something that is not related at all whatsoever, to align this at a time when the flows will dry out and there will be very little liquidity for you to sell sizable positions therein. Uh, if sort of asked to, sort of prescribe on how things will play out, my sense is that larger caps will tend to do a lot better over small and micro caps over the next year or so.
What's your third idea?
So I think we covered multiple second, third, fourth idea therein. But if I list down sort of, so earnings slowdown is not as temporary as you think. Continued flows can't drive fundamentals. Then obviously the virus won't harm directly, but will act as a catalyst to sort of realign narratives. So that's what we discussed. Long-term returns
Right.
in individual.
So staying on that for a minute. So what is your take? Even in COVID-19, of course, it became really big, and then there was a big drawdown in 2020. You think investors and markets are wiser to that even this sort of a pandemic cannot really keep markets down for a long time? Or would you think that the circumstances in terms of fiscal headroom, the inflation problems that we have today, all these things related to Trump, which are expected to be inflationary and so on, those things could actually make it much worse?
COVID may not be as sort of reflective of what might happen next, because, as I said, first time sort of it can surprise the market. The next time people are a lot more aligned, their memory is reasonably sharp and recent, and that sort of doesn't create an emotional or a behavioral, the theater effect. Now, theater effect is basically like you have, say, 500 people inside an auditorium and a very small gate to exit. If somebody shouts fire, then obviously it will result in a stampede. That was exactly what happened during COVID. We didn't know how the businesses would react. To that end, basically, when this started happening, then people started rushing out of the markets, and they realized that many of them couldn't join the action back. And then the markets have had a run of its life in the last 4.5 years or so. So the same factors have never resulted in sort of market correction. So it will be something else this time around. If you ask me what will it be, I have no answer to this. But I can more or less certainly say that the same scare will not let the markets correct twice. For longer, 1 or 2 days, I can't really comment, but for longer, that can't really drive it.
Fourth idea.
Fourth, I was thinking that how sort of a lot of us have been taught that a good stock and a business is always a great investment. We have previously spoken in different shows at your and my conversation, Mahalakshmi, that that was an outcome of how the memories played tricks with us. So if you were an investor in the early 2000s and you saw the rally until 2020 with minor speed bumps in between, you saw how India's economy grew, sectors and companies grew phenomenally, and those businesses were chased by funds external to India. So international investors, their ownership grew from $8 odd billion in the early 2000 to almost 600 billion by 2020. They ended up owning a predominant part of the free float market cap in India. They were 2.5 times the size of mutual funds at their peak. So when earnings kept on growing, so much money was chasing a good quality assets that P's kept expanding. So equationally E goes up, PE goes up. That means price kept on going up, and all of us, the current crop of fund managers, have been brought on the belief that your job is just to identify a great company, and that automatically stays a great investment. Anecdotally, that's still true, but when you look at the data, for example, if I look at the current BSE 500 companies, 346 of them have been listed for more than 10 years. Of those 346, 200 odd companies have had a less than 0% return at any time during the last 30 years for almost a decade. So 200 plus of the 340 companies have had a decadal return of less than 0% since sort of 1992. So that's 60%. And I can present that data across indices, right? IT, auto, FMCG, consumption, capital goods. So if you take sort of a fund manager and ask them that, look, identify 60% of these companies from your portfolio that over the next 20, 30 years will have a period of 10 years of little or no returns, then it doesn't sit well with our line of thought. But that is how things have transpired over the past 3 decades. And I think there might be time again when that happens, given the excesses that gets built out in a few sort of sectors and stocks. So I think we might be wise in CY25 to start thinking of a few of those businesses where the implied valuation is so high that even if the earnings growth keep happening, the stock price may not react very positively for an extended period of time.
So what you're trying to say is don't get wedded to your stocks for the long term, and you have to keep reviewing it. At what period? At what periodicity would you advise that?
So I'll tell you what we do. We essentially build out a thesis.
Or just look at it as, just look at implied growth on an ongoing basis and keep weeding out stocks that, are crossing the threshold in terms of what is sustainable growth.
Build out a thesis. If the implied growth is, above what you would consider normal, like one of those shipyards we discussed was discounting that India will make sort of 11 new aircraft carriers, which is equivalent to the US fleet just in the next decade or so, then obviously that wasn't happening. Now stock has halved. People might still think it will come back to its previous size, but that may not happen in a hurry. So where sort of things get so obnoxiously overpriced, that's when you sort of decide to take some money off the table.
And what's your fifth idea?
Fifth idea, we can discuss it in a fashion that aligning portfolio sort of beta is much better than taking very large cash calls. Behaviorally speaking and statistically speaking, right? So 10 sort of the, if you were an investor in the early 2000, you would have seen close to 6,000 trading days in the past 25 years. Of this, 10 days have driven almost 60% of all gains, and 25 days have given 84% of all of the stock returns. Obviously, no strategy can be created to identify those days. That's not the central argument. But if you are taking an extended period of cash calls, then that actually results into a behavioral FOMO, situation where you might be forced to get in at the wrong time. The better narrative of portfolio management strategy that we have found is that you align your portfolio, because there are times when you run a very aggressive portfolio, but once market starts pricing in a lot like what is happening today, you might be better off running in a lower beta portfolio. So cash sort of portfolio beta over cash calls is what I would sort of call as the fifth idea for CY25.
Thank you so much, Jigar. Wonderful talking to you as always, and very insightful. And there is a lot of wisdom there, although you are not the age of Warren Buffett, but a lot of wisdom in here. Thank you so much.
Thank you, Mahalakshmi. Pleasure as always talking to you. Thank you.